Okay. Can't bet against the market. Lou, thank you for being honest, and you're not alone. Majority of the people do not know how to short the market. It's because this is how we wired, right? We don't know how to short the market. We don't know how to trade against the market. We haven't seen down market since 2008, right? 2000 was very brief, 3 months, right? We haven't seen, we are in the months, what is it, 12 plus 3, we're 15 months into this. Even in 2008, in 15 months, it was over, right? March of 2009, it was all over, right? And market started rallying. Last time market was done for 15 months was 2001, 2003 recession, right? So it does look like and feel like 2001, 2003 recession, but most of us did not trade 20 years ago, right? I mean, I just started my career. I wasn't day trading or actively trading by no means when I was 20 years ago. So this is something new, right? We are preconditioned, right? It's all about the way we are raised and our biases, and to what point did where we were at the right time at the right place, right? If you haven't traded in 2003, this is all foreign to you. You feel like this is anomaly, it's just going to go away, and enough is enough, right? But if you did trade in 2001, 2003, if you traded in 2008, 2009, you feel like, I've seen this before, right? This sounds familiar, right? Then you're cautious, right? So if you don't know how to short the market, you probably didn't trade in 2001, 2003. I'm going to make a bold assumption you didn't trade in 2008, 2009. But you can revisit the history, right? See what actually happened. What were the events that precipitated 2001, 2003 recession, 2008, 2009? I'm not saying we're going to have the same recession, or if we will, but at least you have a point of reference that things can go, can get worse before they can get better, right? So my answer is also 2, right? I didn't trade in 2001, 2003, but it does feel like 2008, 2009. Right? And I've been making these references for a very long time. And I'm going to continue making the reference. Timing-wise, not the same, right? You can see Spiders has been a downtrend 15 months, right? Let's do a weekly chart, right? So we reached the top in January of 2022, and 15 months later, we're still trading in downtrend, right? So it's been 15 months. Last time something like this happened was 2008. We reached the top in October, right? We reached the top of October, and we already 15 months later, right? 15 months later, in March of 2009, we reached the bottom. And right now, I mean, you can argue that we have reached the bottom, right? You can say, listen, this is like 2000, 2009, right? But banks are a lot more well capitalized. This is an exception, right? Silicon Valley Bank, Credit Suisse, First Republic, Signature Bank, these are just anomalies, right? It happens, but we're well capitalized. We have a strong, administration, and they will resolve all the issues. And we have reached the bottom. A lot of people do feel this way, right? So if you're bullish right now, this is your argument, right? We dropped 55% in 2008. Now we dropped 25%. The reason we didn't drop 50% because low unemployment, resilience. We don't have mortgage-backed securities. We're not giving out loans to everybody, whether they can or cannot afford. Completely different situation. There's one way argument. The other argument is just, it's just going to take longer, right? If you're in a bear camp, you basically say, well, it's not like 2008, right? But it does feel like 2008, because if you go back into history, right, what happened? First, Bear Stearns Bank collapsed in April of 2008. Okay, so this is Bear Stearns, right? So Bear Stearns collapsed in April, right? JP Morgan bought it. Government stepped in and said we're going to do anything in our power, and Spiders actually rallied, right? Spiders actually rallied into summer, right? Spiders rallied into summer, and then there were a few hedge funds, just like Tiger Global, right? Went bankrupt, right? We're probably going to hear something like this again. throughout the year. I'm not saying this, right? And then the market, basically everybody says, well, you know, this doesn't feel like a good environment to, you know, hold a lot of positions going into summer. Everybody's sold into summer, right? And the next trigger, right? Lehman, right? This is Lehman. When Lehman went out, right, that was punch one, punch two, right? Second trigger, right? Basically saying this is a systematic issue. This is not a idiosyncratic issue, but this is a systemic issue, and then market dropped. I'm gonna trade, and I look, like people ask me, what do you think about technology? What do you think about this? Right now, I'm basically looking at 2008 as like a playbook of what you can expect in, you know, going into the end of the year. Whether this is going to happen in September or it's going to happen in May, I have no idea, right? But the point is you need trigger, right? You need trigger. Right, you can argue, well, Credit Suisse is a trigger. Well, they got financed, right? They bail out. If over the weekend, regulators come out and say, listen, you know, Credit Suisse is, and this is a, you know, too big to fail bank, right? Because too much debt, and we have run on banks in Credit Suisse, or Credit Suisse have to file for bankruptcy. Well, that is a trigger, right? That would be a Lehman-like moment, right? Right now, obviously, Signature Bank, Silicon Valley Bank, liquidity issues in Credit Suisse. This is not a Lehman moment. This is a Bear Stearns moment, right? Bear Stearns was considered to be an exception, not a rule. Lehman was considered to be a systematic issue, right? So we need this kind of systemic issue. Whether they're going to come from, you know, Tiger Global or multiple hedge funds going under, or some distress in BlackRock Group with their holdings of, you know, corporate debt or real estate. I don't know. That I don't know. I don't think anybody knows. But it does. But I'm going to operate under assumption that we will have this moment. Why? Again, very simple argument. Basically says, well, 2-year yield is still 4%, right? We went from, you know, 1% to, you know, 4.75. Inflation is still here, right? CPI data was worse than expected. PPI is still elevated, even though it did drop. So the Fed is stuck, right? The Fed, I mean, they can pause, and you could see ECB decision yesterday, right? They raised by 50 basis points. Most likely, Fed is going to raise by 25 basis points. So nobody is lowering the interest rates until there is a systemic issues, right? And right now there are no systemic issues, right? So the Fed doesn't want to break, you know, create panic, and they're staying the course. And their course is 25 basis points raise, then they pause and they observe. And I think what they're going to observe is they're not going to, inflation is not going away, right? We have low unemployment, everybody's spending, and high interest rate will stay to a point where you're going to have something like a Lehman moment, and then you have a drop. And then it becomes the question, how far? I like the argument, bull argument, is that this is not 2008, 2009. Banks are well capitalized. So this was 50% drop, right? In 2008, 57% drop. I don't think we're going to have average bear market coupled with a recession. I think we're going to have some kind of a recession, mild, or is about 44%, right? So I think it is reasonable to expect that sometime between now and October or end of the year, we will drop, let's call it 44%, right? So 280, 300, right? 40% would be from the top, 40% would be around 280, right? So I think it's reasonable to expect that potentially we can drop to 280, right? When we're going to drop to 280, I don't know. What would be the signs we drop into 280 is this support, right? First is we are trading right at the, we are retesting again multiple times December lows, right? So December lows. This is a line in the sand, right? I would say if, well, I'm going to phrase it. Bull argument is that we may or may not retest the lows, right? So I don't think bulls are going to just capitulate if we break through this level, let's say today, right? We're down 1.5%. I mean, it's already, so probably not this week, but let's say next week. Next week, let's say another candlestick down, right? We have one candlestick down, second candlestick down. Let's assume we're going to have another candlestick down, right? Next week. And then following another week down, right? Fed is going to talk, right? The next trigger or next event is Fed is going to speak on Wednesday. If they are unable, right? Lagarde did a good job to calm the markets down. She said, we're raising 50 basis points because we don't want to cause the panic. We don't see any issues in the credit market, right? Everybody defaulted to truth, right? I was referencing Talking to Strangers, right? Very good book, right? Like a lot of people ask me, Vlad, it doesn't make sense. They raised interest rate by 50 basis points when Credit Suisse is falling apart and they have liquidity issues. And credit swaps are widening, right? No, the buyers don't, the banks don't trust each other, right? The credit default swaps are widening to historic level, right? To 2008 type of range. And Lagarde is raising by 50 basis points. This does not make any sense to us. And I basically said, well, if you want to make sense out of this, you read this book. If you read this book, then you understand why people default to truth, right? When strangers tell us, don't panic, and banks are well capitalized, and we're ready to do anything to avoid the credit crisis, and we just stay in the course, people default to trust and to the truth until they don't, right? Until they don't. So this is the same kind of moment, right? First punch, maybe people default to the truth. If Powell comes out on Tuesday and people don't trust him, right? If the traders or investors don't trust what he's going to say, then the market continues to drop, right? So we'll see it next week, right? I think people will trust, right? Most people default to truth, right? Unless they were raised in, totalitarian environment, that they don't. But if you're raised in Western culture, you default you do default to truth. So most likely, next couple of weeks it's the opposite, right? We go up, right, after the Fed. And then only in May, just like in 2008, May, June, July, this is when we're going to break this level and reach this level. I mean, so it could happen next week or it could happen in June. In 2008, it happened in June. In 2023, it could happen in March. I don't know. But I think this is my core scenario. Goes up and then it goes down. So I would watch this level, very important level, right? We're testing it multiple times. So next week after the Fed, by Friday, we have to be above 380. If we're below 380 or 378 on Friday of next week, then I think next time we reach this level, it's not going to hold, right? Because a lot of people assume we're not even going to reach this level. So I think, next time we drop to here, it'll be probably bounce back and then sharp drop, right? And that would be followed by some kind of a panic, right? This would be a panic sign. So you don't really have to know when it's going to happen or try to predict this black swan event, but don't fight the tape, right? If you do see break below 380, then that's a warning sign, right? That's a yellow card, and if it drops below, right, this is a yellow card. This would be a red card, right? If you're watching soccer and you're a soccer fan, right? Yellow card, red card. If you do, I think core scenario, we bounce up, right? And then as long as we bounce up and we're trading in this range, it's kind of no event, right? This is just headline news. One day Credit Suisse is going under, the next day they're getting $300 billion. So based on the headline news, it's going to go up and down. We went down today. Why? Well, because macroeconomic data doesn't really look very good, right? The leading indicators, right? Leading indicators are worse than expected, even though it says positive. I'm not sure why. I thought it was negative. I'm not sure of this mistake, but I thought it was negative. And consumer sentiment dropped significantly, right? From 67 to 63. All right, it's 10 o'clock. Any questions on? And again, history is a very important lesson. Actually, if you want to know why technology is going up right now, right? That's $1 million question. You just go back to 2008, right? 2008, right? Bear Stearns collapse. What the technology? Sorry, that's spiders. And QQQ had a very big rally, right? underperforming value stocks, right? That was this year. Everybody said, don't buy technology. Like in December, soft landing guy says, forget the technology, forget the high beta. It's all about, oil and industrials and banks, right? That was, you turn on TV, that's what you hear in December. In 2008 it was the same thing, right? Drop the technology. So everybody dropped technology in 2008. Then banks collapsed, and everybody said, "Well, forget the value stocks, right? That's crazy. Let's just move to technology because the interest rate dropped, and technology almost made, almost retraced all of the losses, 2/3, right? Huge rally going into May, right? Then in June pull back again. People, so something like this can happen again, right? If you want to know what's going to happen to technology, well, Bear Stearns collapse here into May, strong rally, right? Strong rally, and then people said enough is enough, right? And then drop, and then second drop, right? So you could have, this is a reason, if you want to know why technology rally, well, just look at 2008 price action, gives you an answer, right? And the main paradigm shift is we're trading in recession, right? Before it was an inflationary trade. What do I mean by that? Either the treasury market, right? Last year was the record year where both treasury market and equity market dropped precipitously. Usually one drops, one rallies, right? Or doesn't drop as much. You can, the money flows either from treasury market or bond market into equity market, or from equity market to bond market. That is a historical correlation. Because of this hyperinflation and rapid rise in interest rate, last 12 months was an exception. That has changed significantly in the past week. Right now, if you look at TLT, right, treasury goes up, spiders goes down, right? Spiders go up, treasury goes down. So it's all about interest rates. Why? Because every time 2-year yield is dropping below 2%, there's a disconnect between what Lagarde is saying and what Fed is saying and what the bond market expects. Bond market expects that the Fed will pivot this year, and they will actually drop by at least 100 basis points. Why? The only reason they would do this, either inflation completely disappears, or we have systemic issues, and they already, everything that they took off their balance sheet, right? They took off $600 or $400 billion last year off the balance sheet. Fed assumed it all of them right away in the past week, right? Everything that they've done in the past 14 months had wiped out because they assume responsibility and bailed out all the depositors, right? And most likely will, hold these asset classes from the banks that went under. So, right, either the treasury market correct or the equity market correct, right? I believe that you pay attention to bond market, you pay attention to 2-year yield. 2-year yield has this huge drop in the past 2 weeks. It's staying below 4%. If we have continuation next week, the sell-off will accelerate. If we bounce back and retrace some of these losses, right, after the Fed speak, okay, then the market will have a short-term rally. So it's all about 2-year yield, and just keep in mind that correlation has changed. When yield drops, you have spiders drop, right? And technology is outperforming because of the drop. And that's the new correlation that I encourage everybody to pay attention to.